I want you to imagine, just for a second, the absolute most vital engine of the modern digital economy, like the thing that is single-handedly powering artificial intelligence, global finance, cloud computing, all of it.
Yeah, and your first thought is probably, silicon chips, or maybe some incredibly complex large language model living in a server rack somewhere.
Right, exactly. But it's not. The true engine, the one that actually makes the entire digital world possible, is the physical electrical grid. I mean, wood poles, steel towers, high voltage wires, massive
You
substations.
really can't have the cloud without the ground.
Yeah.
It's funny because the more invisible and wireless our technology becomes to the end user, the more heavily it relies on massive, heavy, highly visible physical infrastructure.
Oh, definitely. And today we are doing a deep dive into that exact tension between the digital future and physical reality. We're looking at a highly revealing stack of sources, specifically FirstEnergy Corporation's Q1 2026 earnings presentation.
Which is titled Focused on Our Future.
Yeah, exactly. Published on April 28th, 2026, along with their accompanying official press release. So our mission today is to figure out how a seemingly traditional old-school utility company is sitting right at the epicenter of a massive, unprecedented technological gold rush.
Because the stakes here are critical for the broader economy. We are examining an entity that has to perfectly balance, that daily, unglamorous reliability that you expect. Like when you flip the switch, the lights just have to come on.
Right, no exceptions.
Exactly.
Yeah.
But they have to balance that with an explosive, almost violent surge in demand from the tech sector. And they have to do all of this while navigating an incredibly complex, slow-moving regulatory environment across multiple different state jurisdictions.
Okay, let's unpack this, because before we get into the wild future of AI and data centers, I think we need to understand the sheer financial muscle that FirstEnergy is flexing right now, just to rebuild the baseline grid.
Yeah, you have to look at the foundation first.
Exactly. Their Q1 2026 results show a company in aggressive motion. We're talking GAAP earnings of 70 cents per share, which translates to $405 million. That's up from $0.62 in Q1 of 2025.
And if you look at their core earnings, which, strips out special one-time items to show their ongoing operational performance, that hit $0.72 per share. So that is a 7.5% increase year over year.
Right. And those numbers represent a fundamental shift in how utilities operate, don't they?
Oh, absolutely. Traditionally, utilities are viewed as slow, steady, income-generating stocks. You buy them for the dividend, not the growth. But what stands out in this report is the velocity of their capital deployment.
Yeah, that really caught my eye. In just the first 3 months of 2026, FirstEnergy deployed $1.4 billion in customer-focused capital.
Which is a 33% increase from the first quarter of 2025.
$1.4 billion in 90 days. I mean, that means roughly $15 million a day is being pushed into the physical system.
It's wild to think about that level of daily spending.
It really is. And this is all part of their massive Energize 365 capital investment plan. They are slated to spend $6 billion in 2026 alone.
And zooming out, the total plan between 2026 and 2030 is $36 billion. Just for context, that is a nearly 30% increase from their previous 5-year plan.
So they essentially looked at their old blueprints and realized they were vastly underestimating the physical requirements of the next decade.
Yeah, exactly. And the financial markets are clearly endorsing this aggressive expansion because of the disciplined way the capital is being managed. Like, their consolidated return on equity, or ROE, is sitting at a very healthy 9.8% on a trailing 12-month basis.
And Moody's upgraded FirstEnergy Corp's outlook to positive in March 2026, affirming their investment grade rating.
Right. And we also see this massive investor appetite in the recent debt activity. I mean, they executed an $850 million debt offering in Pennsylvania that was more than 5 times oversubscribed.
Wait, 5 times oversubscribed?
Yep.
That means for an old-school utility bond, Wall Street was throwing over $4 billion at them, just desperately trying to lend them money they didn't even ask for.
Pretty much. People want a piece of this infrastructure boom.
Ugh, crazy. I want to try and visualize what this $36 billion Energize 365 plan actually looks like in practice. To me, it's like trying to completely rewire and upgrade the concrete foundation and electrical system of a massive historic apartment building.
Right, but you can't just kick everyone out.
Exactly. You're doing it while all the tenants are still living there, streaming Netflix and running their microwaves. You can't just turn the building off for a year to do the work.
And taking that analogy a step further, you also have to get permission from the Tenants Association and the City Housing Board for every single wire you pull.
Yes, the regulatory nightmare.
But The crucial detail in their Q1 report is where that newly injected capital is going. Of that 33% increase in Q1 investment, 90% went into what they call formula rate programs.
Formula rate programs, what exactly are those?
So these are specific regulatory mechanisms focused squarely on grid reliability and resiliency. By focusing on formula rates, they basically bypass a lot of the traditional drawn-out regulatory hearings.
Oh, I see. So they essentially have a pre-cleared menu. They know if they spend, say, X dollars on upgrading a substation to be more resilient against storms, the regulatory framework already guarantees they will earn Y return on that specific investment.
Exactly. That highly predictable framework is how FirstEnergy is able to confidently reaffirm their long-term guidance in this report. They're projecting a core EPS compound annual growth rate near the top end of 6 to 8% through 2030.
And aiming for a 10% compounded annual rate-based growth, right?
Right. Building a larger, physically stronger asset base through pre-approved channels directly translates to reliable earnings for the shareholders.
But, that raises a massive question for me. How does a traditional utility company whose core physical business model has barely changed since the days of Thomas Edison suddenly justify a 30% jump in a 5-year capital plan?
You definitely don't just decide to spend $36 billion on grid upgrades in a vacuum.
Exactly. You do it because you are looking at an absolute tsunami of demand hitting your specific service territory.
And that tsunami is tech. The explosive growth of artificial intelligence and cloud infrastructure is fundamentally rewriting the energy map of the United States. And FirstEnergy is sitting directly in the blast radius.
Okay, here's where it gets really interesting. Let's look at FirstEnergy's data center demand pipeline from their earnings presentation. The numbers are just staggering.
They really are.
For the year 2035, their forecasted pipeline demand sits at 13.9 gigawatts. To put that in perspective, a 14.9 gigawatt pipeline is the equivalent of trying to plug multiple major metropolitan cities into the grid simultaneously.
It's a colossal amount of power. And the velocity is what really catches the eye. That pipeline is up 15% just since February 2026.
2 months. It went up 15% in 2 months.
Yeah. And it has more than doubled since February 2025 when it was sitting at 6.1 gigawatts.
That acceleration is completely unprecedented for physical infrastructure.
Oh, totally. And we aren't just talking about a theoretical pipeline here. Their actual contracted demand, meaning ink on paper with specific entities for 2035, is currently 4.3 gigawatts.
And that contracted number alone is up 47% since February 2025.
Right.
I have to play the skeptic for a second, though, because, tech companies love to secure resources just in case. Like, they hoard talent, they hoard chips, so it makes total sense they would try to hoard power.
That's a fair point.
Right. So how much of this 14.9 gigawatts is phantom demand? Are these real guaranteed projects, or is this just Silicon Valley hype filtering down to pad a utility company's earnings deck?
What's fascinating here is how strictly FirstEnergy defines that pipeline to filter out exactly that kind of phantom demand. In their earnings materials, they explicitly outline their methodology.
Oh, really? How do they filter it?
To be included in that 14.9 gigawatt figure, the customer must possess a reasonable level of construction confidence.
Meaning they have actual, undeniable physical skin in the game.
Right, exactly.
Yeah.
The customer usually needs to have legal control of the physical property.
Yeah.
They need to be actively engaged in local zoning and permitting.
Oh, so they can't just be kicking the tires?
No, not at all. They need concrete development plans filed, or there has to be a formal public disclosure of the project.
Yeah.
FirstEnergy is deliberately screening out the tech companies who are just calling up and asking to reserve a gigawatt for a rainy day.
That makes a lot of sense. And the geographical breakdown of this demand tells a really compelling story about where the digital economy is putting down its physical roots.
The state breakdown is super revealing. Ohio is the undisputed heavyweight champion in their portfolio right now.
Yeah, they are looking at 7,005 megawatts of total demand by 2035 in Ohio alone, with a 5,000 megawatt pipeline.
And then you have Maryland right behind them at 5,360 megawatts total. Pennsylvania's at 3,195 megawatts.
Yeah.
West Virginia at 1,800 and New Jersey at 1,755.
Silicon Valley might have the software, but when I look at Ohio and Maryland, I see two things: massive land availability and the PJM grid. Is this just a pure real estate and resource play by big tech?
Honestly, it comes down entirely to physics and geography.
Yeah.
FirstEnergy operates within the PJM interconnection region.
For those who might not know, PJM is the regional transmission organization, right?
Yeah, think of it as the air traffic controller for wholesale electricity. It coordinates the grid across 13 states and D.C. PJM has the heavy transmission infrastructure required.
which these data centers desperately need.
Exactly. But more importantly, AI data centers require monumental gigaliter volumes of water for cooling their server racks. You literally cannot build these facilities in a desert.
Ah, right. The cooling demands are insane.
Ohio, Pennsylvania, and Maryland have the freshwater resources, the stable geology, and the transmission arteries to support this. So FirstEnergy is uniquely positioned geographically to be the literal power source for the AI revolution.
But, all of this massive digital infrastructure is entirely at the mercy of the physical elements, which brings us to a fascinating vulnerability in their Q1 data, the weather.
Oh, the weather is huge.
Right. We have this $36 billion upgrade plan, and we have this massive 15-gigawatt AI data center pipeline. But day to day, a utility's bottom line is still just tied to the thermometer.
The wire sale summary in the report illustrates this beautifully. It shows exactly how sensitive a utility's earnings are to the physical environment.
Yeah, in Q1 2026, they track something called heating degree days, or HDDs. It's basically a measurement of how cold it is and how much people need to heat their homes.
And what happened with the HDDs?
The HDDs were 2% higher than in Q1 2025. And that tiny 2% weather fluctuation, a winter that was just marginally colder than the last one, actually added a full penny, 0.0101 cents, to their earnings per share.
That single penny highlights the sheer scale of their daily operations. A slightly colder winter means more electricity continuously running through millions of meters, which drops straight to the bottom line.
It's incredible. Overall, their total actual sales were up 1.2%. Commercial sales led the way, up 2.8%, residential was up 0.7%, and industrial was up 0.5%.
But while they can forecast the weather, the much larger variable they have to manage is the regulatory environment.
Oh man, the regulations. They have to go to state commissions and legally ask for permission to charge customers for all these massive grid upgrades.
Right. Let's look at Ohio, for example. FirstEnergy is submitting a 3-year rate plan, proposing roughly $800 million annually in investments.
That is nearly 15% higher than their current plan. But here's the kicker. They are projecting residential customer bill impacts of less than 3% annually.
That seems like a math trick, right? Meanwhile, in West Virginia, they are making a massive physical generation play. They filed a Certificate of Public Convenience and Necessity, a CPCN, for a new 1.2 gigawatt gas combined cycle power plant.
Along with 70 megawatts of solar, I believe?
Yes, exactly.
Let's actually break down what a CPCN is, because it's vital to understanding how utilities operate. Utilities earn a guaranteed return on the physical assets they build. Therefore, they have a natural incentive to overbuild.
Right. The more they build, the more they earn.
Exactly. So the CPCN is the state's legal defense mechanism. It's the utility having to prove to the government that this $1 2 gigawatt gas plant is absolutely necessary for the public.
So they aren't just building a massive power plant to inflate their own rate base and pass the cost to consumers.
Precisely. And that legal burden of proof is intense. In their filing, FirstEnergy explicitly states this new generation is to address the existing baseline needs of West Virginia customers.
However, they also strategically note there are potential incremental opportunities from data centers. They are laying the groundwork to serve the tech sector while justifying the build based on current residential and commercial needs.
Sneaky, but smart. I also have to highlight the forward-looking risk factors section of the report because it honestly reads like a macroeconomic thriller novel.
Oh, utility risk models are fascinating. They have to plan for literally everything.
Yeah. They list severe weather, geopolitical conflicts, inflation, supply chain disruptions, and they also have to list specific federal tax legislations.
Which ones do they call out this time?
The report calls out the Inflation Reduction Act of 2022 and the recently signed One Big Beautiful Bill Act of 2025, which was signed on July 4th, 2025.
What's fascinating about reading a utility's risk models is how emotionally detached they are from national politics.
Oh, absolutely zero emotion.
Right. Whether a piece of legislation provides tax credits for renewables, alters corporate tax rates, or incentivizes domestic manufacturing to a utility planner, it's not ideology, it's just impartial math.
They just take those federal tax credits, plug them into their 20-year integrated resource plans, adjust their capital expenditure models, and move on.
Exactly. It's just inputs for the spreadsheet.
So what does this all mean for the person turning on their lights? I want to go back to that Ohio rate plan because it really does feel like a mathematical magic trick.
The 3% bump.
Yeah. How does the math work where a company can spend $36 billion over 5 years, build a massive new 1.2 gigawatt gas plant in West Virginia, but confidently project that everyday families in Ohio will see less than a 3% annual bump on their monthly power bills?
It's the billion-dollar question. How are they not passing a massive rate hike down to the residential consumer to pay for the AI revolution?
Right.
If we connect this to the bigger picture, the secret lies in two mechanisms: formula rate recovery and the economics of demand growth.
Okay, lay it on me.
First, as we discussed earlier, 75% of their projected investments are in formula rate recovery. This drastically reduces what is known as regulatory lag.
And regulatory lag being the time between when a utility spends $1 billion laying new wire and when a judge finally proves a rate case 3 years later, allowing them to earn a return on it.
Exactly. The formula rates shrink that timeline. It makes the financing much cheaper and more efficient, reducing the overall carrying cost of the debt.
That makes sense. What's the second part?
The second part is even more crucial to the residential customer's wallet. Think about how a power grid's costs are distributed. A massive portion of grid costs are entirely fixed. You have to build the poles, the high-voltage wires, and the substations, regardless of whether people use a little power or a lot.
Right. The infrastructure costs the same to build, no matter what's flowing through it.
When you introduce a massive influx of industrial and commercial demand, like a 14.9 gigawatt pipeline of data centers, those new users are buying astronomical quantities of electricity.
It's gigawatts of it.
Yeah. And the sheer volume of electricity they purchase means the fixed cost of maintaining the overarching grid can be spread out over a much wider base.
Oh, I see. They become the new anchor tenants. Going back to our apartment building analogy, it's like a developer coming in and adding a massive, ultra-luxurious penthouse to the roof.
I like where this is going.
The new penthouse owner uses so much power and pays so much in building condo fees that it covers the foundational repairs for the rest of the building. And that keeps everyone else's rent increases down to 3%.
That's a perfect way to look at it. The scale of that anchor tenancy changes the entire economic model. Theoretically, this massive commercial growth shields the residential ratepayer from bearing the full brunt of these multi-billion-dollar grid upgrades.
Because the data centers are footing the bill for their own massive usage.
Exactly. The data centers pay for the bulk of the infrastructure they specifically require, and their massive, continuous 24/7 usage subsidizes the broader system stability.
It's a delicate balance to strike, for sure.
It is, but that is the exact value proposition FirstEnergy is presenting to its regulators. They're basically saying, we will build the infrastructure to secure your state's economic future in the tech boom, and we will do it without shocking your residential voters' utility bills.
It really brings the whole picture into focus. When we synthesize the findings in this Q1 2026 report, you really see the dual identity of FirstEnergy right now.
Yeah, it's like two companies in one.
On one hand, you have this rock-solid, incredibly stable utility play. They are offering a total shareholder return opportunity of around 12%. They have a committed dividend growth, targeting a 60 to 70% payout ratio of their core EPS.
And they are aggressively maintaining their investment-grade credit metrics.
Right. So for an investor looking for a safe harbor, it behaves exactly like a traditional utility stock.
Underneath that calm, dividend-paying surface, however, they are sitting on a 15-gigawatt data center pipeline that effectively makes them a stealthy tech infrastructure growth stock.
They really are the physical bottleneck for the cloud.
They absolutely are. A tech giant can have all the capital in the world to build an AI supercomputer. They can have the most advanced silicon chips ever manufactured. But if FirstEnergy doesn't upgrade a substation to connect them to the PJM grid, those chips are just very expensive paperweights.
That reality makes you look at those steel transmission towers differently when you drive past them, doesn't it? They aren't just carrying electricity anymore. They are carrying the future of the digital economy.
That physical transmission infrastructure is rapidly becoming the most valuable real estate in the tech world.
Which leaves me with a final thought for you to mull over. For decades, the big tech companies in Silicon Valley have been the undisputed masters of the digital universe. They build software, they design chips, and they iterate at lightning speed, completely unburdened by the physical world.
But the physical world always catches up.
It always does. Because as artificial intelligence requires unprecedented, mind-boggling amounts of physical electricity, these tech giants are suddenly finding themselves entirely reliant on regional utility companies, entities bound by slow-moving regulatory rate cases and the physical limitations of copper wires.
It's with the paradox.
It really is. So the question is, As this bottleneck tightens, will tech companies simply accept being at the mercy of utility timelines? Or are we going to see a future where tech giants, flush with trillions in capital, decide to bypass the public grid entirely, either by building their own private nuclear networks or by simply acquiring the regional utility companies outright? Next time you see a high voltage tower, ask yourself who might actually own it a decade from now.